This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading tight bull channels. I'll begin by talking about what I mean when I call a channel a tight bull channel. And when a channel is tight, it's important to realize that it is simply a breakout on a higher time frame, and therefore traders should trade it like a very strong trend. Trade only in the direction of the trend. Sometimes when the market's in a tight bull channel, it starts to get a pullback in a tight bear channel. Usually it's a bull flag and the bull trend resumes, but sometimes if it grows to 10 or 20 bars, traders begin to wonder if the bears are taking control. That is an endless pullback, and it can have a bear breakout, and it can be the start of a bear trend. Channels can be either very tight or very broad. Very tight bull channel. When it looks like this, you should only be looking to buy. And you buy for any reason. You buy reversal attempts, you buy bull closes, you buy breakouts above prior highs, you buy at the market. It doesn't matter. The odds are the market's going higher. Very high probability of making profit if you buy. On the other hand, when a channel looks like this, and it pulls back 3 or 4 bars, 5 or 10 bars, yet keeps making higher lows and higher highs, you always should be looking to buy because it's still a bull trend. However, bears will often sell at and above new highs because the pullbacks are deep enough for them to make a profit. Bulls should buy. In general, when you're getting deeper pullbacks, it's better to be buying pullbacks than buying breakouts at new highs. The bulls take profits at new highs and they buy pullbacks. Because the pullbacks are often deep, certainly deep enough for the bears to make money, bears will sometimes sell for scalps. For example, a second reversal down. The market tried to reverse down below this bar and did not go down, and then it went down again below a bar here, far enough down for a scalp. Here, traders might sell below a strong bear bar above the prior high, or they might look for a second entry sell. Here we have a double top, an attempt to resume up, and then a second reversal down. Here's a 5-minute chart of the euro versus the dollar. It's important for traders to distinguish between a very tight channel and a broad channel because you're going to trade them differently. When a channel is very tight like this, very difficult to make money selling because the pullbacks do not fall far enough for bears to make money. However, when the pullbacks start to last a lot of bars and fall further, bears can start making money. It's basically a trading range that slopes somewhat up. You should still always look to buy. However, traders will start selling, looking for scalps. There are ways that I use to classify a channel as tight, and the more things that you see, the better it is to only buy. For example, here's a pullback. Did not even fall below the low of the prior bar, and it only lasted a bar or two. Another pullback. Average bar is about 12 pips tall in this particular chart, but the pullback is less than 2 to 3 times as big as the minimum scalp. When you're trading in the Forex markets, you should always be trading for at least 10 pips. You'd like to have pullbacks that are at least 2 to 3 times as big as a minimum scalp. You want to be seeing pullbacks that are 20 or 30 pips before you start to short. And if the pullbacks are not 20 or 30 pips, then you should not be shorting. Additionally, you don't want the pullbacks to be much less than 2 times the size of an average bar. Here, a pullback from this high to that low is only 14 pips. That is not 2 times the size of an average bar, and it's too small to be making money selling. Whenever you see a stop entry, here we have a bear bar, consecutive bear bars. Here we have a micro double top, but the market's not falling far enough to make money. Here we have a lower high, and the bears, if they sold, did not make money. So stop entry setups are mostly losers, even when you have decent sell signal bars. That tells you that there's something wrong with selling, and that you're probably in a small pullback bull trend, a very tight bull trend. The pullbacks only retrace about 1/3 to 1/2 of the prior leg. Here we rallied and we reversed. The pullback retraced a little bit more than half of the leg and not all the way down near the bottom of the leg. The market also tends to form gaps. The market reversed up and pulled back, but this low stayed above this high, and therefore there's a gap. Traders who sold this high and scaled in higher were unable to make money. They needed the pullback to fall below this high so they could get out break even on this sell with a profit on their higher sell, and they were unable. The same here. Traders have a gap between this breakout point and that low. The market broke out strongly here, and traders who sold the breakout were unable to make money selling. Once you conclude that a channel is tight, never trade against the channel. For example, in a tight bull trend, you should never be shorting. The pullbacks are too small for you to make money. You might make money occasionally, but you'll lose money most of the time. And after 10 trades, you'll discover that you have lost money. Bears will lose money selling in a tight bull channel, and therefore traders should only look to buy. All trends, including tight channels, are forming wedge tops. First push up, pullback, second, third. But the pullbacks are small and the channel is very tight. We have a spike up, a pullback, a second leg up, a pullback, and a third leg up, and a second entry short, yet it's still too tight for the traders to make money selling. All trends are constantly forming wedge tops. Just because you see a wedge top does not mean you can make money selling. When a channel is very tight, like that and like this, never sell. In fact, anytime you see a sell setup, you should buy. Wedge tops, the market ignores them, and instead of reversing, it pulls back into a bull flag and the bull trend continues up. Don't fight the trend is up, and all trends are constantly creating reversal patterns. They're going to fail, and whenever you see one, you should do the opposite. If you see a sell setup, buy it, don't sell it. Beginners, weak bears are constantly selling in bull trends because the risk is small. Micro double top here, second entry short, here's the first below that bar, here's the second, and the risk is only to above either this bar or that bar. Beginners like to sell because they think about risk all the time. They ignore probability. The probability of making money selling when a channel is this tight, especially selling this far below the high, very small. The same is true here. A second entry short after a wedge top. The risk is small. You put a stop up here. Beginners love to take trades like this. However, just because the risk is small is not enough reason to sell. You have to consider reward and probability. The reward is not going to be big enough because you're selling too far down in a bull channel where the pullbacks have been very small. And the probability is very low because a very strong bull trend usually does not reverse into a bear trend. It becomes a small trading range or a bull flag, and the bull trend resumes. Again, beginners only think about risk. There are 3 variables in the trader's equation: risk, reward, and probability. And a beginner usually has a small account, and all they can think about is risk. And they know if they're selling with the stop near the top of anything and put a protective stop above the high, their risk is small. And for them, that's all that matters. They don't pay attention to the reality that the reward is probably not going to be big enough to make the trade worthwhile. A minimum scalp in the Forex market is 10 pips. And if this is a 5-minute chart, very difficult to make 10 pips when you're selling that far below the top of a tight bull channel. And the probability is very small. And therefore, the trader's equation is terrible. Yes, you don't lose much money, but you keep losing money repeatedly. And by the end of the session, you will have lost a lot of money. The trader can look at this as a buy climax, trying to break out above the top of a bull channel. You can call it a parabolic wedge. Whenever you have a very tight channel with 3 pushes, it's a parabolic wedge. And they can also say it's a lower high in possibly a trading range. And they have a strong sell signal bar for the second signal. All of that is true. Same here, wedge top, 1, 2, 3. However, you cannot ignore how tight the channel is. And because the channel is tight, the probability of making money on a reversal is small. You have to pay attention to all 3 variables in the trader's equation. You cannot sell because bulls are eager to buy, and they'll buy any reversal attempt even if there's a decent sell signal bar and a wedge top. And the buyers will overwhelm the sellers. I want to make an important point about tight channels. They are breakouts on the next higher time frame. If you have a very tight channel on a 5-minute chart, it's actually going to be a breakout on a higher time frame chart. It'll be one or more strong gold trend bars closing on its high. There will be no pullbacks. For example, here's a 5-minute chart of the euro versus the dollar. There's a pullback here, there's a pullback here, a bear bar and a pullback here, bear bar, bear bar, bear bar, bear bar, and a pullback here. But if you look at the 30-minute chart, a couple time frames higher, this is what you see. You see a series of bull bars closing on their highs, and as soon as the bar closes, the low and open of the next bar are right around that close. Very little pullback. The market's rallying strongly. And therefore, even though you're seeing pullbacks and bear bars on the 5-minute chart, the next time frame up or 2 time frames up, you don't have any of that. And that's because a very tight bull channel is, in fact, a breakout on the next higher time frame. Would you be selling if you look at this? Of course not. And therefore, you should not be selling when the next time frame down has reversals, because the reversals are going to be too small to make money. Five-minute channel because we're getting pullbacks. However, when the channel is very tight like this, the channel is going to be a breakout on a higher time frame chart. And therefore, you should only trade it like a breakout, and that means you should only buy. If you see a channel and you're seeing pullbacks and you're starting to get some bear bars and you're wondering if the channel is tight, well, one thing you can do is look at the next higher time frame. Here's a 5-minute chart. You can look at the 15-minute chart or the 30-minute chart. And if it looks like this, that tells you that when you look at this 5-minute chart and you're starting to see reversal setups, do not sell. Here, it's a micro channel. Every low is at or above the low of the prior bar. Very little overlap between the bars. A breakout, no pullbacks. Once you start getting pullbacks, it's a channel. As a beginner, you might look at that and say, well, it's pulling back. Maybe it'll pull back far enough to make money selling. No, it's not. The pullbacks are too small. And that means selling is a low probability way to trade, and you will lose money. Despite the pullbacks, It's still a subtle, very strong trend, and the reward is big. When you see small pullbacks, the odds are the market's going to go a lot higher because on our next higher time frame chart, it's a breakout, and breakouts tend to trend a long way. If you're constantly looking to sell, when you look at a chart like this, look at the next higher time frame and trade that higher time frame chart. For example, if you see this, trade it like a breakout. Just buy at the market, buy closes, buy for any reason, and then just hold. Sometimes the stop is far, but that's always the case. When the probability of making money is high, the risk-reward ratio is going to be worse, and it usually means the trend is so strong, moving up so quickly, the stop is going to be far below. But it's still reasonable to take the buys because the probability of making money is so high. Just trade small enough so that you can use the appropriate stop. And the same is true here. If you're buying for any reason, the pullbacks are small, you need to put your stop below the most recent major high or low, way down here. The risk is big, however, the probability of making money is very high. I want to talk a little bit about a type bear channel as a bull flag. This is a strong bull trend. It's a 5-minute chart of the euro versus the dollar. The market went sideways here, 3 pushes down, 1, 2, 3. You can call it a tight trading range or a triangle. Here it pulled back for 2 or 3 legs, 1, pull back 2, pull back 3. If you want, you can call it a wedge bull flag. But it's a bear channel in a bull trend. It's a bear channel that was a bull flag. This is a horizontal channel. A triangle is a horizontal triangle, and it's a bull flag. The odds are there'll be a bull breakout, and again here, and the bull trend will resume. Whenever you see a reversal attempt in a bull trend, especially a type bull channel, which is a strong bull trend, the odds are it'll fail and become a bull flag, and the bull trend will resume. Traders will buy a reversal up. Here we have a high 2 bull flag, leg 1, pullback, leg 2, and a bull breakout, and then a pullback from that. If you want, you can call it a triangle. Here we have a high 1, pullback, high 2. Reasonable to buy above the high of this bull bar. You get filled here. If you buy above this bull bar, you're going to put your stop below the bottom of the most recent major high or low, a strong breakout to a new high. Sometimes the market will trade above a bull bar like this and have another push down and then continue up. You could also buy closes after 3 or 4 consecutive bull closes, breaking out above the bear channel. Bear channel, bull flag. You expect a bull breakout. Whenever you have a bear channel and a bull trend that grows to 10 or more bars, you have to start to wonder if the bull trend has ended and if the bear channel is going to become endless. Is it going to become an endless pullback and a bull trend? And if it is an endless pullback and a bull trend, at some point you have to decide that it's a bear trend. A pullback is more likely to become endless and break into a bear trend if it's following a buy climax. Here we have a bull bar, a bear bar, a pair of bull bars, a doji, 3 bull bars, a bear bar, a big bull bar. This is consecutive buy climaxes, and that's a type of a topping pattern. You can call it a parabolic wedge. You have a series of 3 or more legs within a type bull channel, and that often leads to a deeper pullback. And then here you have 4 consecutive bear bars. Once you have 3 or 4 bear bars with 2 or 3 of them closing on or near their lows, you have to be thinking that the market may get a couple legs down. Here, 1 leg down, pullback, 2 legs down. Does not matter that the pullback went above the top of the bear trend. It's a pullback from this reversal down. This is a second leg down. But here we have 5 consecutive bear bars, mostly closing on or near their lows. This is probably going to result in at least another leg down. At some point, you have to conclude that at least a little bit more down is likely, and the odds start to favor the bears. After you've had 3 or 4 bear bars, traders will start to sell closes like here or even right here. And here we have an outside down bar and a bear breakout bar and a bear follow-through bar. we're probably going lower. It might result in a measured move down. First leg down here, and then bear breakout. And then you have to be thinking maybe a measuring gap, second leg down. It does not matter that these highs went above the breakout point. They only went above a little bit and the market sold off. So I call that a negative gap, and it still can result in a measured move down. You can see more about this in my videos on tight channels and micro channels, on pullbacks and bar counting, and on major trend reversals. Sometimes you get a tight bull channel forming in a bear trend. However, if the market's still always in short, that tight bull channel is a bear flag, and therefore you should only sell. Here we have a very tight bull channel lasting 6 or 7 bars. However, look to the left. It's in a very strong bear trend, and therefore this is almost certainly a minor reversal, which means the best the bulls will probably get is a trading range. More likely it'll be a bear flag. A trading range means it might go up, down, and up. Then the odds are still favoring a continuation of the bear trend. So a brief, strong reversal in a very strong bear trend, it's still probably minor. The bulls will need some kind of a double bottom before they can get a major reversal, and therefore selling, even when the rally is this strong, is a high probability bet. The best that the bulls can probably hope for is a trading range, and if you sell, you can avoid a loss and you'll probably be able to make a profit. Sometimes, rarely, this will keep going up and create a very strong bull reversal. Unlikely. More likely, you either get a resumption of the bear trend, and this is a bear flag, or the market goes sideways. If it does go sideways for enough bars, then bulls can start looking for a major trend reversal. And once it enters a trading range, traders will make money buying. But that's not the case when the reversal up is the first reversal in a very strong bear trend. If you looked at this as a reversal, a major reversal, you had to be disappointed by what followed. This is not enough to make the market always in long. Therefore, it's still always in short, and that means it's more likely to go down than up. In other words, the probability still favors the bears even after this series of bull bars in a very tight bull channel. We have a very strong gold breakout here, and we have a reversal attempt here. That is a pullback, even though it did not fall below the low of the prior bar. It's probably the start of a channel. The market's always in long. You can buy at any time. Strong gold breakout, clearly always in long, which means the odds are very high that we're going higher. Strong breakout usually results in some kind of a measured move up, possibly from the open of the first bar of the breakout to the close of the final bar of the breakout. You look for a measured move up. Here we have a reversal attempt. Even though it did not trade below the low of the prior bar, it's still a pullback, and that usually means the market is going to start to begin to have pullbacks, and therefore it's entering a channel phase. Sometimes you look at a chart and you say, I don't know, is that a tight channel? Is it a broad channel? The reason why you have to make that decision is because if it's broad, you can probably start making money selling. However, if you look at a channel and you really cannot decide if it's broad enough to be selling, only buy. Also, whenever you think a channel is reasonably tight, it's always good to be swing trading at least part of your position, because the trend will probably last a long time. If you cannot tell if it's tight or broad, assume that it's tight and trade it like it's tight. Trade it like a breakout, because it probably is a breakout on a higher time frame chart. a pair of bear bars, a very strong bear bar, but is it deep enough for the bears to make money? I don't know. You need to make 10 pips to make a trade worthwhile. And here we're simply testing the bottom of the most recent bull breakout, forming a double bottom. The bears need strong follow-through after this bear bar for traders to believe the bears are in control. When a bull channel is this tight, chances are the reversal down, even if it's briefly very strong, is probably minor, and the odds favor a resumption of the bull trend. This reversal down only lasted 2 bars, 1, 2. After the reversal down, we have a doji bar, not strong follow-through, and then we have a bull bar, a higher low, and a 50% pullback. We're still always in long, not enough reason to sell. Bulls will bet the bear reversal will fail, and they'll buy on a reversal up, especially above a bull bar. Here the bears have a micro double top. We went up, and then we went down. We went up, and then we went down. However, then we have a bull bar. Traders will assume the bear reversal will fail, and the bull trend will resume. They'll buy above the high of this bull bar, a high 2 bull flag, a small double bottom bull flag. We went down, we went up, we went down, and now we're going up again. Sometimes you'll have a channel that is reasonably tight, but it has brief pullbacks that are deeper than what you typically see with very tight bull channels. However, the pullbacks are brief, lasting only a couple of bars, and they're not falling far enough for the bears to make money. Now, is this a small pullback bull trend? Whenever you see a rally that looks like a bull leg in what will become a trading range, you have to be thinking about the possibility that it's a small pullback bull trend and that it will continue a long, long time and not turn into a trading range. Here we have some overlap between this breakout point and that pullback. Here we have a little bit of a gap, maybe a slightly negative gap, maybe slight overlap between the pullback and the breakout point. Doesn't matter. The channel is tight enough so that traders should not be looking to sell. It doesn't have to be strong enough to conclude that it's a small pullback bull trend and likely to go up for a lot of bars. It's still a tight enough bull trend so that you should only be looking to buy. You can use your emotions as radar. If you're looking at a trend like this and it's trying to reverse, trying to reverse, trying to reverse, here we have a wedge, 1, 2, 3, trying to reverse, here we have a double top, and you're feeling agitated because you want a deeper pullback, and the pullbacks never seem like they're deep enough despite all the bear bars. Your emotional radar is telling you that you believe that the trend is very strong. When that's the case, you have to buy. The stops are obvious. When the market's doing this, the stop is down here. Here we have a reversal up to a new high, and it's a strong breakout. Buying at any point after this, your stop is obvious. It's below this breakout, which is the most recent major higher low. If you're uncertain what stop to use, for example, if you buy above this bar, do you put a stop below here, the buy signal bar, or down here? It's usually better to use the wider stop. Put the stop below the major higher low. It increases your risk, but it also increases your probability because it's fairly common for the market to have a second or a third leg down and then resume up. Reasonable stops initially. Once you see this, the stop is here. And then once you break to a new high with a series of bull bars, stop is here. Once you start to get a series of bull bars and a new high, you raise the stop here. And same here. Once you start to get a series of bull bars, on the 4 or 5 bull bars, and you're up at a new high, raise the stop. Here we have a strong breakout. The biggest bull bar late in a bull trend. It could be a climactic end of the trend, and the market might be transitioning into a trading range. I would move my stop to below its low because this might be the exhaustive end of the trend and the transition into a trading range. When the market's in a fairly tight channel, you always feel like it's not quite strong enough to be buying at the high, but it's never pulling back far enough so that you feel like you're minimizing your risk. It always feels like the market's trying to reverse and that a huge reversal can occur at any time. But the reality is, whenever a channel is tight, any reversal is going to be minor. That means that the best the bears will get is a trading range. More likely, the sell-off will be a bull flag and the bull trend will resume. Is this a trading range? No. I think a trading range needs legs down, legs up, legs down. You do not have this. You have a very tight channel, one leg down, and therefore it was a bull flag. However, beginners, when they look at this, they keep seeing all of the reversal attempts and all of the bear bars, and they're very afraid that the market will suddenly reverse into a bear trend. However, when a channel is very tight, despite all the pullbacks, the reversals are going to be minor. 70 or 80% chance the reversals will be minor, and therefore the odds are very high that the market's going higher. And because the market is going to go higher, and you cannot keep waiting for the perfect pullback, you have to buy at least a small position and then use the appropriate stop. And you can buy for any reason. You could simply buy at the market. Even if you have a buy climax late in a bull trend, you can buy that because the first reversal down at best will be minor and lead to a trading range. Therefore, even buying this high close does not have much risk. You can buy more lower, betting that the bears will need at least some kind of a double top for a major trend reversal, and that means that any sell-off will come back and test this high and allow you to get out without a loss. In general, when you have a big bull breakout late in a bull trend, it's better to buy a pullback instead of buying the close. But even if you do buy the close, the worst possible price, you usually can avoid a loss. Wherever you buy, if you're really not certain where the stop should be, use a stop below the most recent major higher low. Because as long as the market continues to make new major higher lows, it's in a strong bull trend. If it drops below a prior major higher low, then it's no longer in a strong bull trend. It's then either in a trading range or possibly a bear trend, in which case you do not want to be long. And therefore it makes sense to use stops below prior major higher lows. For example, if you buy this close, you could use a tight stop here, but even if the market gets below the low of this bar, odds are it'll get back up to this close again. And therefore, it's better to use a stop below the bottom of the most recent leg up. Strong breakout to a new high. This is a major higher low, and putting a stop right below it is the best thing to do for your stop. Again, whenever you have a channel, even if it's getting pullbacks, the odds of the bull trend reversing into a bear trend are small unless the market first transitions into a trading range. And therefore, even buying high is not a problem because you can buy more lower and get out when the market tests back up high. The bears need a trading range, which means they need at least a double top. They need the market to go down and then up, and then they need it to reverse a second time. So if you bought here and you had a surprisingly deep pullback, chances are the market will come back up to your original entry and you'll be able to avoid a loss. Remember the market cycle. You have a very tight channel. Therefore, the risk of a major reversal is small. Reversals will be minor, and the market will have to enter a trading range before it can become a bear trend. And that means even if you buy at the worst price, the highest price, the risk is small because the best the bears will get is a trading range. And if it's a trading range, it'll test back up here again, and you can get out without a loss or without a significant loss. Usually, you'll make a profit even buying at the high because most reversal attempts will continue to fail. 70% chance that any reversal will be minor and that the market will test back up. So even if you bought the worst price, 70% chance the worst that's going to happen is that you get out at break even. Here, we entered a tight trading range. The bears hope that this is a lower high that will lead to a bear trend, but is it really a major reversal? No. It only fell for 4 or 5 bars. It rallied for 4 or 5 bars. That pattern is too small to be a major trend reversal. And therefore, this lower high is a minor reversal, which means that the sell-off will test back up again, 70% chance. Despite the lower high, it's still always in long. That means it's still more likely that the market will go up than it is that it will go down. If it goes sideways for more bars, then the bears might be able to create a credible major reversal. However, when you're getting a reversal after only 10 bars in a tight trading range, that is almost certainly going to be minor, which means a bull flag. When you see a strong breakout to a new high, 4 or 5 bars up, 6 bars up, bull bars closing on their highs above the prior high, you can raise your stop from this major lower high to below this leg up, because at this point, this is a major higher low. As long as the market stays above prior major higher lows, the odds favor it continuing to go up. The bull trend is still intact. We have another double top very late in the session. We're about 80 bars into the trend. We have 4 consecutive bear bars here. You have to be thinking that the market probably will begin to transition into a trading range and that the bulls will start to take profits. Pullbacks might get deeper. 4 consecutive bear bars here, 2 closing on or near their lows. And now we have 5 consecutive bear bars here, again, closing on or near their lows. The market now is probably transitioning into a trading range. That means pullbacks might become deeper, and you should begin to trade it like a trading range instead of like a strong bull trend. Four consecutive bull bars here, 5 consecutive bull bars here. We have a double top late in the session, 80 bars into the trend. You'll get some profit taking. Traders will conclude that it's probably no longer a tight bull channel and it's probably transitioning into a trading range. Whenever there's a buy climax, the odds are you'll get a couple legs sideways to down. 1 pullback, 2 sideways here. A buy climax, 1 pullback, 2. A buy climax here. This entire thing is a buy climax. 2 legs down, 1 pullback, 2. Another buy climax, 1 pullback, 2. But 5 consecutive bear bars here, 4 consecutive bear bars here. The selling pressure is much greater, and it increases the chances of this becoming a trading range rather than a continued bull trend. It also increases the chances that the bears will get a deeper reversal, maybe down to the bottom of the most recent strong leg up, maybe to the bottom of the most recent major higher low. Once you get 3 or 4 bear bars, bears will start selling above bars, betting that there'll be at least a second leg down. Here we got a second leg down, and then a third leg down, and we broke below a major higher low. Once it breaks below a major higher low, it's no longer a bull trend. It's then either a trading range or a bear trend. And in this case, it was a bear trend. Most bulls, once they start to see 3 or 4 consecutive bear bars, will exit, either on the close or on a reversal up. If they held through this, they'll get out either on the close of the 3rd or 4th bar or at the high of the prior bar, betting that there'll be at least a small second leg down. And it's no longer a strong bull trend. They don't want to be trading it like a strong bull trend. If it finds support and rallies, they might buy, betting on a trading range. But now we're in a strong bear trend, a tight bear channel, and the reversals up are minor, and the bulls will wait to buy until the market stabilizes and starts to go sideways. Three-bar bull breakout, very strong bull bar closing on its high, and then we have a follow-through bar. Probability is we're going up for at least some kind of a measured move, and that means the probability of making money is high. However, so is the risk. Whenever you have a very strong bull breakout, the probability of making money is high. The probability is we're going up for at least a measured move. But whenever you have a high probability setup, the risk is always going to be big. You cannot have a high probability and a strong risk reward. When you see this, you know the probability for the bulls is high, and that tells you that the risk reward is terrible, and that usually means that the risk is big, that the stop is far. There's always a trade-off. There always has to be a reason for someone to take the other side of the trade. If you're buying here, someone is selling to you. You have a high probability of making money. They have a low probability of making money, but their risk is small and the reward is big. The market has a pullback, and now we're channeling up, buying at the top of the bull leg. The probability is still high that you're going to make money, but it's not nearly as high as the probability buying right here. Usually, that means the stop is not as far as well. The risk is less. The risk buying here is to here, and the height of this red box is smaller than this. The stop for these bulls is closer than the stop for these bulls. The risk is smaller than it is over here. I began by talking about what I mean by a tight bull channel. And when a channel is tight, it's a breakout on a higher time frame chart, and you should only be trading in the direction of the trend. And also, sometimes a tight bear channel can begin to form inside of a strong bull trend, a bigger tight bull channel. It usually is a bull flag. So a bear channel, bull flag. However, if it grows to 10 or more bars, and if it follows a biclimax, like a parabolic wedge top, and it starts to get a series of 3 or 4 consecutive bear bars, the odds begin to increase that the bears could get an endless pullback. The bear channel could grow to 10 bars, 20 bars, and then eventually have a bear breakout and begin a bear trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading tight bull channels.